plan for retirement can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. I've got a great show planned for you today. This show is based on one of the questions that I get asked probably most frequently when people come into my office for the first time. They're concerned about retiring, of course. When can I retire? And one of the big issues, of course, for that is income. How am I going to have enough income? Am I going to be able to generate enough income? And where is it going to come from? Do I have enough invested or saved to be able to take income from that to live on? And of course, one of the answers to that question is, well, it depends on how it's invested and how that investment is going to then generate income. What kind of risk is in the investment? Is there a possibility that it could go down? You know, this is one of the things. And the idea for today's show comes from these people coming into my office and asking these type of questions. One of them, as an example of what I might see, is where someone's coming in and they're asking, with your, you know, I've got an IRA, I've got a 401k, I've got money put in the bank for savings, I've got so much in stocks, I've got so much in bonds, or maybe in an instance this past week I had a gentleman who had most of his money in CDs and savings accounts. Now what's the problem with that? How much are those earning? At 1% or less than 1%, as many of you know, what is that going to generate? If you've got $500,000 set up in a CDs or savings account or some combination of bank instruments such as that, and they're earning even 1%, all right, $500,000 at 1%, how much is that going to generate for you in income? All right, what we're talking about is about $5,000 a year or $400 a month in income on $500,000. Now, how many people, how excited are you now, right? I'm going to get a whole $400 a month on my $500,000 in savings. Surely there's a better way to go than that. And that's one of the reasons we're going to be talking about annuities today. I'm going to recap a couple of things for you, all right, to help set this up and show you how annuities can fit in for you. And we're going to talk about both the good parts of annuities, the bad parts, you know, things that you want to avoid. And here's the other part. There are thousands, well, let's say at least hundreds, if not thousands, of different types of annuities out there. And we're talking about different types of annuities, not just like fixed annuities, variable annuities, fixed index annuities, but then within those three categories, there are literally hundreds and hundreds of different products that are put out by different insurance companies. So we're going to talk about those. And of all those, by the way, of all those hundreds, if not thousands of annuities out there, there's only a handful of them, right? There's only like maybe 5 or 6 that are really going to give you the benefits that you're looking at, all right? The ones that I would recommend, in fact, to my clients. Now, let me review a couple of things for you, all right? One of them is, you've seen this, me use this on the show many times, and it's in my book, 7 Steps to Financial Freedom in Retirement. And this is your roadmap. This is where it starts. All right. So again, the reason why am I recapping here? I want you to remember whatever those expenses are. We talked about it here. Let me go up a little bit. There we go. Financial Lifestyle Expense Worksheet. You can get it from my office. It'll help you determine what your monthly expenses are, both before and after retirement. And believe me, they're not going to change much. And I find that for many people, even they go up in retirement, not down. But whatever that number is going to be, that number goes in here. That's our guideline for then how much do we need in checking? Well, we need at least 1 to 3 times that amount setting aside to pay our bills. So I would say in this situation, I would lean more towards the lower end, about 1 month's worth minimum. All right. Next, we need about 3 to 6 months for an emergency fund. So again, 6 times that number set aside for emergencies in a money market or savings account. All right. Then the next 5 years, 3 to 5 years worth of planned expenses. Remember, that emergency fund is for the unplanned things, the things that break and we need the money right away. The other is for things that, well, in the next few years, I'm going to replace the car or fix up the house a little more or something like that. We want that money set aside when we're retired and we're not having those wages come in as we had before. Now, what do we notice here? Look at the different rates of return. Historically now, all 3 of these are at 1% or less, especially if you're talking 1-year CDs or even 2-year CDs. I just was with a client yesterday, 2-year CD maturing, and they were getting 1.1% on it. So historically, we're well below these numbers right now, but if you look over time, this is about what they will average. What's the problem? Does not stay ahead of inflation and taxes, right? And what did we just talk about? $500,000 earning 1% is only going to $500,000. I really want to emphasize this, okay? $500,000, and you get $400 a month for income. All right, to not dig into that principle and make sure that that money lasts for your lifetime. So what do we need to do? We need to get better earnings, right? Now, what's the problem with that? Safety, right? We don't want to lose this money. So how can we safely invest to generate this type of 4 to 9% return, depending on what your income needs are going to be, so that that income can be used to replace those wages to help pay those bills each month or replenish an emergency fund or a short-term fund, all right? And I've talked to you about how to do that. Well, this comes the next chart, and you've seen me use this before. Again, it's in the book, and you can get it through my office, The 3 Worlds of Investing. And we just were talking about on those top 3, right? Bank things that are protected, they're safe, CDs, savings accounts, checking accounts, money market accounts, U.S. savings bonds, treasuries. Insurance companies have what are called fixed annuities. All of these work basically the same in that they give you your principal is guaranteed, you're not going to lose any money. Some amount of interest is also guaranteed. There are penalties for early withdrawal. So again, don't take out a 5-year CD if you need that money in the next year or two. Here's the other part. Historically, 1 to 4%. Again, that's over the long term. But even then, it's still not enough to keep up with inflation and taxes, which means we would be losing the purchasing power. But as I indicated, the amount that you need in checking, an emergency fund, and short-term fund, that's still this world, isn't it? Because we need that liquidity, we need that safety, but we need to also limit how much we put here, because we don't want to put all our money there, have that purchasing power go down, or possibly if we need higher income, right? If you've got $500,000 saved as an example, $400 a month, you probably need more than that to live on. So that means you're going to be eating up that money. Your money's going to be going down because you're going to be using more and more for income. So how do you get ahead of that? One possibility is the stock market, things like mutual funds, individual stocks and bonds, what are called ETFs, exchange traded funds, which is kind of like a mutual fund that's traded daily on the market, or REITs, real estate investment trusts. This is another area. There was a time going back some years ago where REITs were very popular with investors and paid a high rate of return. What I'm finding with most of the people that come in with REITs today that have had them is that they're locked in, they can't get their money out, they're not getting any return, and that's because of a lot of what's happened in the market over the last 6 or 7 years, let's say. All right. The other thing, insurance companies have what are called variable annuities. This is one of the annuities. Remember I said we're going to talk about the good, bad, and ugly? I'm going to explain, again, with the variable annuities, I'm taking on this risk where they could go down in value, and I'm adding additional costs, so it's not something I would recommend. What's consistent with all of these? There are no guarantees. Your principal's not guaranteed. You could lose money. Obviously, there's no growth guarantee. You could, again, not only not make anything, but actually lose money. And here's the big one. You need time to be on your side. In the stock market, we have what are called rolling 10-year averages. And basically, that's if you're not going to be in a market portfolio for at least 10 plus years, then you're going to be subjecting yourself to additional risk of a negative return over that period. And we've talked about, and I'm going to talk some more about that here in a moment. And the third world is that of banks have what are called index CDs, insurance companies have what are called fixed index annuities. Here again, we have all these guarantees, right? Principal's guaranteed, interest guaranteed. Again, penalties for early withdrawal, so make sure it matches up with your financial goals and needs. All right, but they have a link to the market. It could be like a stock link, like the S&P 500 index. Could be a Dow Jones Industrial Index, the Russell 2000 Index. You can have a blend of indexes, Barclays Aggregate Bond Index, all kinds of different ones out there, and then how they work. All right. we've covered the basics. We've kind of set things up for you. One of the things that I'm going to do today is I'm going to talk about annuities. And in talking about annuities, I'm going to offer up some things for you today, all right? And that is a free analysis. Maybe you have annuities currently. Do you have variable annuities? Do you have a fixed annuity, fixed index annuity? Maybe you have an annuity or a number of annuities and you're not sure what they are or how they work, or are they really good annuities? So what I'm going to do is I'm going to offer up to anyone interested today, you'll be able to call my office. We're going to get the number up on the screen for you. If you'd like to get a free analysis of your annuities, all right, you can call my office, 376-5325. You'd be able to bring those in to me. You can call me on the phone by the way, with any questions. Of course, call in today. You know, we're going to take a break here in a moment. You got some annuities? Go dig them out. Let's take a look at them. Give me a call if you've got some questions there, and we'll get right into them as soon as we return here on the Retirement Report.